Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1Mby1M, as you know, is the first and only global virtual accelerator for technology startups in the world. We run it from Silicon Valley, but our footprint is completely global. And if you've been here before, you know that we get entrepreneurs from Africa, from all corners of India, from Asia, from Latin America, everywhere, literally. As long as you're comfortable communicating in English. I speak other languages, but I can't really do a mentoring session like what we do here in any other language. I just don't have the comfort, the vocabulary to do that in any other language. So that's perhaps one of the limiting factors that we have. But certainly, there are a lot of English-speaking entrepreneurs there. This is the 561st episode of our free mentoring roundtables. And of course, in the premium program, we have numerous roundtables through the week and through the years. So this format of roundtable discussions has been our anchor format for a long time and very effectively so. The event is being recorded. You will have all recordings available at 1M1M Roundtables. Our Twitter handles are at 1M1M and at Romana, and today's hashtag is 1M1M. This is the audio bridge. You can dial in, and this is a roundtable, not a broadcast. We have scheduled programming first, but you're very welcome to dial in and weigh in. And also remember, you have the public chat and the public Q&A on WebEx, which you can also dial in from. Finally, your computer audio. When we're ready to take audience participation, audience Q&A, your computer audio will also work. You can unmute your line. Today, we're going to start the session with a conversation with Christopher Mirabile, Senior Managing Director at Launchpad Venture Group. Do you go by Chris or Christopher?
I go by Christopher.
All right. Well, Christopher, welcome to the show.
Good morning. Thank you for having me. It's a pleasure to be here.
Tell us a bit about your background as well as Launchpad.
Sure. So my background is I actually was an English major, and I started my career in strategy consulting. And I actually ended up getting a law degree when I was a young person and worked in a very tech-focused corporate firm. And I ended up taking one of my clients public, a big enterprise software company. And I went in-house and became an executive in that company, ultimately as the CFO, and then became a full-time angel when we sold that company to another enterprise software company. So my sort of skill set and background really is in and around technology and software, and I obviously have a pretty good working knowledge of legal and contractual and business related issues.
And Launchpad is it an angel group or is it a formal fund?
Launchpad is a network-based group of about 180 investors with a few affiliated funds, but each of the individuals work on their own. And we put about $10 million to work every year. We've been around for 20 years. We've backed about 130, maybe 140 companies. Had about 70 exits over the years. And our focus is really on science and technology centric companies going to market through B2B go-to-market approaches. And we work on sort of need to have rather than nice to have types of products. So we don't do things like food or consumer packaged goods or gaming or gambling. We really focus on sort of B2B need to have kinds of things in the science and technology worlds.
And within B2B, it's a big focus area for us. B2B, software as a service, AI, platform as a service, all of that is a big focus area for us. Now, do you do both enterprise and SMB?
We're classic venture investors in terms of our psychology. So, we'll look at a company focusing on medium-sized enterprises if we think the market size is going to be big enough to support venture economics. We're a little bit different from a VC fund in the sense that and I'm not telling you anything you don't know, but the typical venture capital fund sort of has a surplus of capital and a shortage of human capital, right? And a network of investors is the other way around. So the difference being that we can get interested and make money investing in a company servicing a 150 or $200 million market in a way that VCs wouldn't. But if you're going after a market much smaller than that, it's kind of hard to make the math work if you're going to try to fuel the business on risk equity because the time and risk adjusted returns just aren't going to be there for a risk equity investor. It's probably not the best kind of fuel to run that sort of engine on.
Great. So you've said a lot of things here that I will double click down on and elaborate. But let me first set the specifics straight. What is the geographical boundary of your investment interest?
Launchpad is based in Boston, Massachusetts, and we really do take a pretty intensive hands-on approach. And so we limit ourselves mostly to the Northeast. Our membership base comes up and down the Eastern Seaboard, but we'll do New England and the New York area and upstate New York. But we tend not to invest that much out of the Northeast.
Okay. Now, let's start with some of the mechanics of how an entrepreneur would work with you. Let's say I want to, send the deal over to you, to your group. How would we work on that? And how do you show it to the 100 investors in your group, et cetera? It's just
Sure. Well, like everything, we get a fair amount of deal flow. So, having a warm introduction is helpful. It's not an elitism kind of a thing so much as a human nature pragmatism sort of a thing. And our members are all available on LinkedIn. So if you search for Launchpad Venture Group on LinkedIn, you'll probably find someone in your network, even if you're an entrepreneur, who's at the beginning of her career, you'll probably find some second degree connection. So that's certainly one way to find a little bit of a warm intro. But any entrepreneur can go right to our website, launchpadventuregroup.com. It's a long URL, and just hit the entrepreneur button and just fill out a short summary profile about the company, and that will put you in our queue. And we will reach out, and we actually have a couple different programs. Sumatra, we have a traditional sort of monthly main forum where companies that are, presumptively really ready to work with investors like ourselves, present. But we also have, and that's usually 3 companies a month. And, there's 2 out of the 3 of them tend to go right into diligence. But we also have a catalyst program, in which we look at about a dozen additional companies a month. And that's really not intended to be as much of a investment forum as an opportunity to begin a relationship, get to know some investors, get some informal feedback. And we poll the participants and give written feedback to every company to try to be helpful. And typically what happens out of a dozen companies in a month is that, about a third really aren't going to be a fit. And we're very, very honest with them about that. So we think it's a sin to waste entrepreneur time. So if it's really not going to be go ahead.
Just in the interest of time, Christopher, let's the way we work is that I will send you deals. If you're working with 1 million by 1 million, I will be sending you the deals, and they're fully vetted to fit or not your I wouldn't be sending you stuff that you would, reject out of the gate. That due diligence is done on our end. So given that, what is the stage? What is the check size that you guys like to write? What stage do you want to come in? What do you want to see in the validation metrics?
Sure. We're typically participating in sort of the classic 500 to $2.5 million
See.
round and kind of seed. I mean, these terms have become meaningless, but we, on average, we tend to invest most frequently right at the point of market entry. So there's a minimum viable product, and there might be a couple customers piloting, not necessarily a lot of revenue, but there isn't a lot of technical risk left in the company. We know the product can be built and it has at least a value prop. And we really tend to be funding that first go-to-market testing of that first go-to-market hypothesis in search of trying to get a repeatable sales model. So that's really the stage we do most commonly.
But you want to see some customer engagement, yeah?
If we know the entrepreneur or we know the category exists, we'll invest as early as the PowerPoint stage. But if it's an unknown or a first-time entrepreneur and it's a speculative product category, we probably, we don't need to see a ton of revenue, but we need to get comfortable that this is going to be a top buying priority for the kind of customer that they're targeting.
Yeah, okay, great. Now, you talked about a specific category that we have been paying a lot of attention to long before, it became fashionable to pay any attention to this category, which is that, smaller TAM than what is considered venture scale. The venture scale TAM typically has been, has to be $1 billion or multi-billion-dollar TAM. And that has left that category of 150, 200, $500 million TAM as a, undesirable category. But my observation has been for a long time that, there's a lot of exits, strategic exits in enterprise software in particular, other kinds of as well, that happen in the, sub 50 million range. And to make money off a sub $50 million exit, you have to build a company in a very capital efficient way, and so that everybody can make money. But that category of like 150, $200 million TAM, where it fits strategically into somebody else's portfolio and can go to market through their sales channel, is actually a very attractive category. And for angels or small funds, it's a very, very good category. So
I couldn't agree more with you. I mean, I feel like you're reading my playbook back to me. And I'll give you a great example of that if you want, just one anecdote.
Yes, I was going to ask for examples, exactly.
We had a great, this is, if this isn't a perfect example, I don't know what is. We had a company that was a SaaS company. It wasn't technically recurring revenue, but it was repeating transactional revenue. They had a lot of repeat customers. And they got a thoroughly mediocre revenue multiple. They exited for 4x revenue. And that deal was a 21x cash on cash return for us and a very good IRR. And the reason for that is that they were very capital efficient. We seeded them about 400K, and then we put another $1 million in. And the team got to a $20 million revenue run rate and got acquired for 4x revenue, clean little cash acquisition for $80 million, and it worked out to a 21x return for us.
There you go. So, by the way, if you're interested in us profiling this case study, please send them to us. We'll do that because we have a bootstrapping to exit track and we consider these kinds of very small amounts of capital invested deals as bootstrapping, basically. You have to be able to get to $20 million with 1.4 million in cash in, you have to bootstrap. And that's something that we really believe in and we really support and promote very extensively. So we're very much with you on this line of thinking. And, like you said, whereas these very large funds can only invest very large amounts of money, otherwise their human capital to capital ratio does not work out.
Yeah.
In your category,
they just can't manage that many deals. It's very hard for them to play.
Exactly, you cannot manage that many deals. That's right. But you have the ability to do that, and that's very attractive.
Yeah, it's interesting. you know, you read about large exits all the time. You think they grow on trees, but
Yeah.
what are there? A handful, a couple dozen billion-dollar startup exits in a year at most, out of something in the ballpark of 400 to 500,000 startups created in the US each year. Statistically speaking, pushing an entrepreneur into a high capital, big exit path is statistically speaking dooming her to failure.
That's right.
The average M&A in the United States is well below $50 million.
That's right.
And there are certain companies where you'd be an idiot not to go big on the capital, right? I mean, there's some that are serving a global market of like Snapchat or Instagram or something, and you've got no choice but to use capital as a weapon and go big. But for many, many entrepreneurs, they're better served by staging capital more thoughtfully and not locking themselves in. There's a lot of different harvest points that
Yes.
on the capital curve, and often entrepreneurs are better served by selling and letting a private equity or a venture capital or somebody else take the business off their hands and going back and starting again and doing the fun part that they like the most.
Yeah. I was talking to an entrepreneur yesterday. This is his fourth rodeo. And this time he's already found product market fit, and it's scaling, and it's going to be a unicorn kind of deal. But his first three ventures were bootstrapping to exit. He got like small amounts of capital. Each time he got like tens of millions in exit, and that's a very successful career, very, very wealthy, career profile.
Yep.
So yes, we are very much in tune, and I would love to. I'm very happy that you came and reinforced this point of view. We've been. If you go back and look at my work, I've been promoting this point of view for 15 years now, and it's been pushing a rock up the hill, because the TechCrunch style media writes about unicorns, writes about how much funding, and it's like, who raised the most funding is the game that entrepreneurs are playing, and the problem is the naive first-time entrepreneurs are learning a bad example that, that's what I need to do because everybody else is doing it, and that's what TechCrunch is writing about.
Yep.
Anyway.
Sometimes I feel like a stodgy value-based investor in a momentum-based world. And, you sometimes will see venture capitalists say that they never focus on exits. Well, I hope their LPs don't hear them say that, because it's nonsense. Of course they do.
You
And
have to
they say that, exiting early is a crime against nature. Well, not if the market size isn't big enough. And forcing the company to take a bunch of capital, it can never pay off. It's sort of like if all you have is a hammer, every problem looks like a nail, and you just jam capital into every company, and it might work out or it might not, but it's basically reckless disregard for the founder's well-being.
Yeah, and another truism that I hate is this go big or go home. That is such bullshit. It's not even funny.
If the market is a truly massive market, it might apply, but in many cases, you're a couple pivots away from a really big market.
Yeah. So let's talk a little bit about what you're seeing in your deal flow as well as in your portfolio in terms of interesting trends. I always like to ask, because that early stage deal flow is indicative of what's happening in the pipeline of technology, pipeline of, interesting developments. What are you seeing? What's interesting?
Well, obviously asset prices are stupid right now. And that's difficult, because doing the kind of investing you and I do, you have to be disciplined about price and about staging capital. So those are difficult circumstances. And I feel like we're in, there's a lot of hype about, crypto and so forth. But we're not paying much attention to that. I'm sure crypto is going to be an important technology down the road, but that's not really a focus for us. I feel a little bit like we're seeing very good opportunity, relatively speaking, in the health and life sciences area right now. It's particularly hot in Boston. And there seems to be in tech, there isn't any particularly well-defined locomotive right this second. The transition from PC to client server, or web services, or internet in the dot-com era, or the mobile. We're in a time right now where it's blocking and tackling. The really, really big companies like Google, Facebook, Apple are just so dominant that it's harder for little startups to really get in and change standards and create new norms. And so there's a lot of little marginal and incremental improvements. We have basic things we have to solve, like cybersecurity. I think 5G will be a little bit of a locomotive once it becomes more widely deployed. But we're not sort of seeing one unifying super hot tech trend right now that's really becoming a train that everybody's jumping on. We're seeing a lot of incremental improvement across a lot of things. We also feel like certain categories like MarTech, digital marketing, a lot of those categories are getting kind of tired.
Mhm.
And you're finding that,
Tech is very, very crowded.
you find a little product market fit and you make a little bit of a difference, and then the tool loses its effectiveness in 6 months. Consumers are fickle. The next thing is just one click away. And so we're being really very thoughtful before we commit money into sort of the ad tech, martech space. Um, and we're spending more time on problems that are sort of buried deep in industries. So, for example, we're working with a company right now that's very focused on one aspect of operations in the self-storage market. That's a market that's growing steadily, but it's also been invaded by some big REITs and private equity firms, and there's a lot of roll-ups, and there's some real business process problems that need to be solved. And so we're working with a company that's doing that. We do a lot of med device, a lot of diagnostic, healthcare IT, digital health. Um, but we'll look at anything, and it doesn't have to be sexy or consumer oriented or planning to build a $1 billion brand. It has to be solving
You
a
know,
problem that people care about.
to your comments about locomotive, I think the theme that we see constantly right now is artificial intelligence and machine learning. Now, that being applied to a lot of small problems, I think, is a perfectly viable way to build businesses. So where there is domain knowledge and where there is, in some esoteric space, is fine, and there you can actually build significant businesses
Yeah,
applying that concept into
I,
vertical SaaS,
I,
basically.
I think you're right to a point. It's a little bit like, it's not an end in and of itself. It's a tool, and there's an enormous amount of hype around what basically boils down to statistics informed decision making. A lot of what's called ML and AI is nonsense. It's really just looking at a medium-sized data set and making a statistics informed decision, and that's great. And I think that AI it's a little bit like a website in 1994. You could say, oh, we have the web, and now every business has the web. Or there was a time when people were saying, oh, I'm a digital marketer. It's like, well, not every marketer is natively digital. So I think AI and ML are really headed towards being very ubiquitous. And I think that for most applications where being 90% correct is good enough, it's an incredibly valuable business tool. And I agree with you that it's an accelerant, and it's a way that a challenger can leapfrog incumbents by investing in better, faster, smarter software. In businesses where 90% correct isn't good enough, and you can't rely on the existing tools out there in open source and otherwise, and you're having to build fresh AI with a fresh data set from bare metal, that is not an angel's game. That is a
That is true. That is
big,
true.
big capital play.
That is true. And we have a big coverage of AI. We have the Thought Leaders in AI series where we cover, and we see a lot of great companies come through. Very recently, we haven't even published the story yet, it's coming. I saw a company called Icera, and that was really impressive. They're not only doing AI-driven customer support, they can actually take over the screen share of the client's or the customer's computer and fix whatever needs to be fixed in AI, full automation. That I think is really impressive. So, and you're right. That is not an angel's game. That requires big capital.
One of the things that I sort of talk about that illustrates your point is that, as a general matter, most startups, their biggest competition is inertia. The existing, good enough, and to break into a market like that, you sort of have to be 10x better, faster, or cheaper. And AI and ML really can be enabling tools to allow you to leapfrog the incumbents. So I agree with you on that, but you have to understand what you're getting into. And an entrepreneur who gets up and she's just hand waving, we have AI, send your checks. You got to dig in a little further than that.
There are a lot of wannabe AI companies out there that are not real AI. They're just buzzword AI companies, and I don't think they're going to get anywhere really. Very good. Well, very nice to meet you, and hopefully we'll have a chance to collaborate in the future.
I'd like nothing more than that. I appreciate you having me, and it was wonderful to get to know you. Thank you for the work you're doing. I think 1M is truly impactful and helpful, and I'm grateful that you're investing in our shared community. So I appreciate what you do.
Thank you. And by the way, my roots are in the Boston area. I don't know if you're familiar. I lived my first 7 years at MIT and Smith College. So
excellent. Come back and see us.
Will do.
It's just like Silicon Valley, except without the hype.
I'm very familiar with the area, and I love it, actually.
Okay. We'll talk to you soon. Happy New Year.
All right. Great. Bye-bye. Nice to meet you. Bye. Folks, we'll do some mentoring work next. And I just want to set expectations. Today, we're going to be working with one of the 1M premium members. So I'm already familiar with his business, and we're going to go further with his stuff. But in general, if you are thinking of pitching at a follow-on session, just want you to know that you are very welcome to come and work here. This is a safe working session. You don't need to be nervous. We're not trying to entertain people by, embarrassing you or any of that. It's a candid, we're on your side, let's work together kind of session. You can disagree with my feedback. It's your venture. You do what you want with it. I will give you candid feedback, though, because that's the only way I can add value. So Dhaval, please unmute your line and let's dive in.
Hello everyone, this is Dhaval Patel. I am a founder of Das Infomedia. We are a company based in Ahmedabad, India. We are 14 years old company, and we develop mobile application, cloud solutions, and softwares for small scale businesses as well as large enterprises. Next slide, please. So this is our company journey. We started our operation in 2007. And we built up our company based providing services like website design, software development. And then since 2011, we started product development on our own. And from 2013 onwards, we are selling on marketplaces, and we are heavily focused on product development. Some of our products are school management system, hospital management system, and team management system. And we have a client base in India, US, and EU. This is our team, myself as CEO and 17 years of experience in IT. Our CEO is Dhaval Patel, 15 years in IT, and Priyal is having 8 years in IT solutions. Next slide, please. Great. This is the part that I love. I think we have three market leading products in a marketplace called Envato. One is school management software. We've been able to sell 1300 plus. Then there is a gym management software, and then there is hospital management software. These are all priced around $55. It's a perpetual license. And we are trying to convert I mean, we are running this business successfully, so that's fine, but we are trying to grow our business. So we are thinking to move on a SaaS-based offering. So these three products, we are thinking that will convert to SaaS and got into the monthly subscription model, as well as we are developing a new product called Yara, which is uh, AI digital employees, more like project management software and task management software. It's a very engaging tool for remote teams. It's a need of our because of pandemic. Everyone is working from home, and Yara would be the nice product to have. Going forward, I think we are trying to focus. I mean, Das Infomedia has been our parent company, and we have built up a brand called Nifty Solve for a cloud solution. So maybe
Nifty Solve.
our Nifty Solve.
What is Nifty Solve?
It's a cloud solution. So we have like, we started with quality softwares that we put it up on cloud. So
The
ISO
Nifty
audit,
brand, it's your own
absolutely.
website?
Yes. Yes.
So, Dhaval, just a second. We talked last time at the private roundtable about something very specific. And I see
Yes.
that that has been completely disregarded and you're presenting something completely off base. Can we go back to what we discussed and kind of continue that conversation rather than starting with something completely
It,
off base?
it is coming in the next slide, but I do wanted
Okay.
to ask, yeah.
Yeah.
So I do wanted to ask whether, I mean, since we are building Yara, which is project task management software, I was just thinking if we can take it in a DAS Infomedia hood, or it can be a separate brand, or it can be a part of Nifty Solve. Since our onboarding process in Yara will be driven by our existing infrastructure on Nifty Solve. So our master database, subscription management, plan management, everything happens in the background through Nifty Solve because that we have already built. That part is already built. So
What you do in the background, in the plumbing, is one thing. What you do in the branding and in the consumer and the customer facing mode is completely a different thing. So I cannot answer this question until we figure out what is the strategy for Yara. And I gave you some input last time we talked on how to research the positioning background of Yara, and I want to hear what you found before I
right,
can't answer this
right.
question.
Okay, let's go to the next slide.
You're putting the cart before the horse is my feedback.
Right, got it. So since I took your core curriculum and I found there are a few things that it can help in Yara's marketing. So our value proposition is for Yara is anytime, anywhere access. So we are on mobile apps and web, and it's best for remote teams and collaboration. And it's a three-in-one solution. So it's Slack, Asana, and Zoom all in one Yara solution. So our customer segmentation looks like this. So we are into B2B space. Our ideal customer would be tech companies, software, digital marketing, or website design companies. And there are other companies who are heavily, computer dependent, can also use our software. So might be a law firms or accounting or BPO companies would be our ideal customers as well. The company size would be 2 to 50 employees. So we are targeting small and medium scale enterprises. Our decision making persona would be CIO, owners, or project managers. And our target market is India, US, and EU. The psychography of our customers would be, I mean, someone young and early adopters of the technology. I mean, someone who is tech savvy would be our ideal customer. Next slide, please. So when we look at the competitive positioning, I think the established player in the segment are Slack, Asana, Monday.com, Aura, and Zoho. Our key differentiator is, we are the only one who has 3-in-1. Like, you can do chat, you can do call, and also you can manage task and team within our software. There are similar offering by Microsoft Team, G Suite, and Zoom, but they'll, that there is some gap that we identify. We identify that if we add another AI layer on top of what existing players are doing, I think it becomes very much faster, very much engaging, because most of the time the software, you are interacting with a computer screen or mobile screen, and it's not engaging. Whereas Yara will bring in a live person whom you can talk to, and once you give command, it's more like Alexa for business. So you give command and it executes for you. The business model that we are thinking will be having a
I don't buy into this. I'm sorry, I don't buy into this. Introducing an AI layer is no joke. It's you just heard in the investor conversation I was having, doing something significant in AI is a very expensive proposition. So if you're telling me that, oh, we're just going to cook together a little AI and that is going to be the differentiator, I don't buy that. That is not a reasonable position. So let's just kind of slow down for a second and answer very specific questions. In this thing, you're saying that you are bringing together Zoom, Asana, and Slack.
Yeah.
Have you checked those three marketplaces? Is there any other player that brings those three together?
We have checked on other marketplaces. So like on Zoom, there are different players who are doing just tasks, or someone else is just doing, the team building. Someone else is just doing, the SMS part. But we haven't come across someone who is doing all the three that we are doing. And there are tons of.
What are those three?
That I don't have over here right now, but we have it in our Excel.
No, what are the three things that you do? You think that you are doing all three and they are not doing all three, they're doing one or two. What are those three elements?
So we are doing task management system, project plus task management system. Then we are doing easy chat. So, you have a whole team on one channel, and you can communicate, like, in morning, whenever you have a call, whenever, there is a stand-up meeting. In Agile, there is a concept called stand-up meeting. So if you are doing a stand-up meeting and, everyone has to be on that call. So, our system has the group call that, since if you have formed the group in our system, you just hit the call button, it gives call to all the members. And there is a chat module, so everyone in the team is connected with the chat. So whatever communication happens in real time, and you can share files, you can share PPTs, and so whole collaboration experience is becoming very fast in our tool. So chat, task, and call.
Is your product ready? Is the Yara product ready?
Yes. So we are just started doing piloting.
So here's my question. Have you checked how to sell that product through the Zoom marketplace, through the Asana marketplace, and through the Slack marketplace?
Yes, I have done that part. So in Zoom right. So in Zoom, I think they have the developer portal. So we sign up with Zoom, and there is some specific requirements. So you need some, icons and some description, and there is the API that we need to consume to do the Zoom integration. And so that's the part that happens on the Zoom. But in our product also, we have to do few integration part, like we have to give customer option to activate Zoom within our system. So that is also something that we are working on. And on the Zoom marketplace part, we have identified how we can place our product in Zoom marketplace.
And what about the others, Asana and Slack?
We have Asana and Slack is little complex. Asana, I didn't find much excitement. So, there are 5 or 6 we tried to identify, but we came up with 3 major players. We will definitely look into Asana and Slack again, but we are prioritizing Zoom, Microsoft Team, and Google Workspace for now. And then later
No,
on,
you're
we
going
can.
all over the place. I can't keep up with you, Dhaval. You told me that your specialty is the fact that you integrate these 3 things, Asana, Slack, and Zoom. Now you're saying there's Microsoft Team and G Suite, so where are we going? Can you please bring me with you and not run off?
Okay, so as we are competing with Slack and Asana, right?
You're
But we are
competing
not
with Slack and Asana.
absolutely. In a sense,
That's a
we are
very
competing
bad idea.
because
That is the worst idea I've heard today so far.
why is it so?
Because these are big players. You don't go front and center with big players like that. You need
Well,
a more refined strategy to be able to get somewhere.
well, that's the tool we are building. We are, I mean, unfortunately, I mean, or fortunately, we are competing with those players. They have particularly, I mean, that tool does one thing that, and they do it well. I mean, and they are the biggest player in that particular category or that particular
You
niche.
told me that you
But
were doing something which brings together Slack, Asana, and Zoom. That
yeah,
integrates the Zoom, Asana, and Slack APIs, and you're building a collaboration tool on that. Did I misunderstand you?
you did misunderstand. So let me put it this way. The Slack does, I mean, if I have to put in common terms, the Slack, what it does is just a chat tool, but it's for business, right? And
Yes.
Asana, it is a task management system. It is not a chat tool, but again, I think it is used for the collaboration. Slack, Asana, both of them are used for team collaboration.
Mm-hmm.
But the way of the collaboration, the way they do it is different. The Asana is more based on task and projects. Slack is more on chat, right? But ultimately, they are catering to remote teams. If I'm a customer of Slack, I would be surprised if my task is not being tracked or not being, I assign a task to an employee and I don't know if he has completed on time or not. If I'm not getting notification, I need to go and check in the system and ask him if I'm using Slack because it does only chat. If I'm using Asana, then, it is good with task tracking. I can assign tasks. I can see what employee is doing, if he has completed on time or not. I can also time it. But the chat experience, I mean, you have to juggle between 3 or 4 different tasks from different employees to understand the whole situation, right? So that's where I think there is a gap. You don't have any single tool where, you don't have to juggle between tools, all available in the
Okay.
same screen.
So let me try to position this for you and see
Okay.
if this is making sense. This customer segmentation that you're showing, this 2 to 50 employee company, you want to provide a Zoom extension product there, where you have not only the video collaboration functionality, but you also have task management and chat and project management. Zoom also has some amount of chatting capability, but you want to provide Slack kind of chatting capability,
Right.
thread management, et cetera, and you want to create Asana kind of task management, which Zoho has as well.
Right.
So, and then Google has that as well. So now you have to anchor. My suggestion to you is you have to anchor on a marketplace and extend from a marketplace. If you try to do this all in vacuum on your own, it's going to be very difficult to penetrate the market. You have to piggyback on somebody else.
Right.
So let's say, based on what I heard today, I think I misunderstood what you said last time, but based on what I heard today, Zoom is the marketplace that you're going to piggyback on. You're going to extend Zoom to have these additional functionalities. So my next question to you is there any other player in the Zoom marketplace that extend Zoom to provide the Slack Asana kind of functionality? And aren't there players within Zoom, and isn't Zoom itself offering integration with Slack and Asana, in which case that problem is solved?
No, I think there is issue. Let's say if we I agree. I think Zoom is the most popular if we consider the remote collaboration. But the chat that happens in Zoom, it doesn't happen. It doesn't stay globally. You can't go back in history and track it. You have to save the chat
Understood.
first,
That's
right?
where Slack comes in. Doesn't Zoom integrate with Slack already?
They do. They do. Absolutely.
There you go. So then what is the case for your coming into this space? Where is the gap in the market? If you've done the core curriculum, you know I'm constantly advising you to find the gap in the market. Where is that gap in the market? Zoom and Slack are integrated. Zoom and Asana are integrated. Slack and Asana are integrated. So where do you come in? Where is the gap?
So you don't need to purchase 2 or 3 softwares. I mean, let's say if I am a consumer, I have purchased Zoom. I don't want to additional cost of Slack and additional cost of Asana, you know. I want all in one. Maybe I don't need to pay 3 guys to just do one thing that I need. And
Okay.
I don't want my employees to sign up to 3 different services, that's cumbersome.
Okay. All right. So then I want to see an analysis of the TCO, total cost of ownership. In a Zoom, Asana, Slack integration, what would the total cost of ownership be? And how do you price to compete with that? You can say that, okay, we are going to do Zoom. You're going to buy Zoom because otherwise we can't access the Zoom marketplace to distribute. But then instead of Slack and Asana and the cost structure of Slack and Asana, you can get that functionality by paying such and such amount to Yara. So that comparison is your competitive positioning. And then you're going to need to find out if anybody else directly features in that competitive landscape.
Okay, got it. I can do that.
Got it? So that analysis is going to determine whether there is room for you or not. Because the problem you have is the momentum of Slack and the momentum of Asana, especially Slack. Slack has incredible momentum out there and has very, very deep pockets. Now they're part of Salesforce.com. As it is, they were a successful public company. So there's tremendous momentum. So, and then you also need to see what Zoho is doing, because Zoho is a very smart company. And Zoho plays in that space that you talked about, this 2 to 50 people company, employee company. Zoho is very big in that space. So what is Zoho's strategy? If Zoho were competing with you, does Zoho have a Zoom integration, and do their task management and does Zoho have a Slack Asana competitor that integrates with Zoom, in which case that's going to be also something that you're going to need to analyze. And the same thing, this Monday.com, Aura, I'm not familiar with these guys, but you have to do the comparative analysis to see how all that plays, assuming Zoom is your marketplace where you're going to be playing. So now that we have this, so are you with me so far?
Yes.
Yes. Now let's go back and answer your question about DAX Media, Yara, Nifty Sol, and all that. So what you need to analyze is, if your primary sales engine or go-to-market engine is the Zoom marketplace, then how is that? You need to understand how to sell on the Zoom marketplace really well. Just like you figured out Envato, you need to figure out the Zoom marketplace really well to see how do you sell. And your brand is going to be Yara. I think the product that you're going to be selling on the Zoom marketplace is going to be Yara. But then what is the workflow of how that transaction happens? You have to understand how Zoom is set up and how you set up. I don't know if Nifty Sol has a role in this. I'm not sure. It could very, I think it would confuse the customer if you bring in that many brands. If Yara is the product that you're going to sell on the Zoom marketplace, I would just create a whole landing page around Yara and how to sell, how for the customer who comes from Zoom Marketplace to buy Yara, just lands on Yara and completes the transaction on Yara. Whatever technology you may be using the Nifty Sol technology, but if you confuse the customer with 3 different brands, DAS, Infomedia, Nifty Sol, Nifty blah, 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 Yara, the customers, you're going to lose the customer.
Got it.
Make sense?
Yeah.
So now I could answer this question because now this is so the answer to the question comes in a reverse order. You have to first understand positioning, first understand go-to-market strategy, then you can decide what brands and how and when.
Okay. All right.
All right? Okay, so the next conversation we're going to have, whether it's private or public roundtable, it doesn't matter, is that analysis, that much deeper competitive analysis, assuming that Zoom is your go-to-market strategy, and then, you know, what is the pricing of Slack plus Asana plus Zoom? Can you compete in the Zoom plus Yara mode with the Slack plus Asana plus Zoom product, you know, portfolio? And are there other Zoom integrations that you need to worry about that you will be pitted against? Is there a Zoho to Zoom integration and this other stuff? So that's our next conversation.
Yeah, excellent. I'll do that. Thank you.
All right.
Thanks,
Good progress. Okay. Folks, I don't see other hands up, but I will let you guys figure out who else wants to talk or ask questions. So you can also ask questions in public chat. Here's a quick rundown of how to use 1 million by 1 million. You can go to 1Mby1M.com. Everything is there. You can start by reading the blog. The Entrepreneur Journeys book series is available at a very reasonable price. These roundtables happen every week. We have the full acceleration program, which Dhaval is part of, and that offers you extensive methodology guidance, coaching, just like what we were doing just now. You will get help with financing and media relations. You will get help with business development, as you have access to the 1M by 1M curriculum. Do the self-assessment. It's a very useful free tool which is basically the due diligence process, the VC due diligence process that you can run on yourself. Try to answer these questions. Our bootstrapping course is a free under 1 hour course that is available on the blog. Definitely do that to get a feel for bootstrapping and the philosophy that we use. You will find a lot of learning material, new learning material that we have released on Udemy. And those courses are very reasonably priced, and they're all based on the 1M by 1M methodology. A very good starting point. Our entire curriculum is available as 1M by 1M basic curriculum only for $99 a month. So go dig around on the website, basic, premium, you know, what to expect, FAQs, video FAQs, etc. Curriculum is described in detail. It is a case study-based curriculum. We have thousands of successful entrepreneurs who have been part of this program, and we have the investor introduction policy also clearly outlined. You do need to bootstrap first and then raise money later. You need some level of validation. In the conversation today, you heard from Christopher that and he echoes most investors' point of view. They want to see, you know, some amount of customer traction before they're willing to write checks. So do not go to investors as beggars, go as kings. If you're a first-time entrepreneur, you will not be able to finance a concept. You're going to have to finance a business. That is all. We have 4 roundtables in February, lots of options to come and pitch. So see you then. Irina is your contact for further questions on the program, Irina at 1Mby1M.com. Any other questions, comments, input, introductions before we adjourn? Yes, no, people? All right. I don't see any hands up. Looks like everybody is done. So I will see you next week. Take care. Stay safe. Bye.